IFRS 15, the new language of business. Are you confused about revenue recognition? You're not alone. IFRS 15 is here to clear things up. This standard creates a common language for businesses worldwide. It ensures everyone reports revenue in a consistent and transparent way. This is essential for investors and analysts. Before IFRS 15, companies had different ways of recognizing revenue. This made it difficult to compare financial statements. IFRS 15 simplifies things. It provides a single principle-based model. This model is based on 5 steps. These steps guide you through the entire revenue recognition process, from identifying the contract to recognizing revenue. IFRS 15 provides a clear roadmap. IFRS 15 impacts all companies that generate revenue from contracts with customers. Whether you're a small business or a multinational corporation, understanding IFRS 15 is crucial. It's time to get with the program. IFRS 15's 5-step model takes the guesswork out of revenue recognition. Let's break it down with some simple examples. Step 1. Identify the contract with a customer. This seems obvious, right? But not all arrangements qualify. There must be enforceable rights and obligations. Think of signing a lease for an apartment. Step 2. Identify the performance obligations in the contract. What exactly are you promising to deliver? If you're a baker selling a custom cake, your obligation is to bake and deliver that specific cake. Step 3. Determine the transaction price. This is the amount you expect to receive from the customer. For the cake, it's the agreed upon price. Step 4. Allocate the transaction price to the performance obligations. If there's more than one obligation, divide the price fairly. For example, a phone contract might include the phone and a year of service. Step 5. Recognize revenue as each performance obligation is satisfied. This is the heart of IFRS 15. You recognize revenue when you transfer control of the good or service to the customer. The baker recognizes revenue when the cake is delivered. These 5 steps provide a clear framework for recognizing revenue. It's all about accurately reflecting when you've earned it. Sometimes the transaction price isn't set in stone. Welcome to the world of variable consideration. This occurs when the amount you'll receive depends on future events. Imagine you're a software company offering a bonus if the software hits certain performance targets. The bonus is variable consideration. You must estimate this amount based on probability. IFRS 15 provides guidance on estimating variable consideration. You can only include amounts you expect to receive, and you need to update your estimate if circumstances change. Variable consideration adds complexity to revenue recognition, but IFRS 15's guidelines help you navigate these tricky situations. Remember, it's crucial to be realistic and update your estimates as needed. Section 4. Contract modifications rolling with the punches. Business is full of surprises. Sometimes contracts need to be modified. IFRS 15 provides rules for accounting for these changes. Let's say you're building a website for a client. The client decides they want additional features. This modification affects the contract price and possibly the scope of your obligations. You need to determine if the modification creates a new contract or changes the existing one. This depends on the significance of the changes. If it's a new contract, you'll follow the 5 steps again. If it's a modification, you'll adjust the transaction price and obligations accordingly. Contract modifications can be complex. IFRS 15 provides a framework for analyzing these changes and ensuring your accounting remains accurate. Don't be afraid to consult with an expert if needed. Section 5. Overtime or point in time. Timing is everything. When you recognize revenue is just as important as how much you recognize. IFRS 15 offers 2 methods, over time or at a point in time. Revenue recognized over time is for long-term projects where control is transferred gradually. Think of a construction company building a bridge. They recognize revenue as they complete stages of the project. Revenue recognized at a point in time is for shorter-term transactions. This is when control transfers immediately upon delivery. The baker recognizes revenue for the cake at the point of delivery. Choosing the right method is crucial for accurate financial reporting. IFRS 15 provides criteria to help you decide which method is appropriate. Remember, the goal is to reflect the economic reality of the transaction. When is control truly transferred to the customer? That's the key question.